Hi, welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. We're a couple of days later this week as we have the big monthly review and outlook for June, which is available on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on top of our content. We love these monthlies as they cover so much. Basically, you can consider your portfolio positioned after you read it. Jeff, welcome back. I hope you enjoyed your long weekend. We haven't spoken since before then.
No, I did not enjoy it. I spent 3 days working on this publication, and then I had to spend into the midnight hours last night trying to finalize all the details with the
Oh,
midweek close. But, I actually did find some time to relax. I took a bike ride, celebrated my mother's 80th birthday. So I did fit in a few things. Yeah, I guess I did enjoy it a little
well,
bit.
happy birthday to your mum, belated. And I thought you'd be happier because you didn't have me peppering you on Tuesday.
Oh, I've had less time to prepare than I usually do. So.
There we go. Well, we have lots and lots to get through. So let's dive right in and start, as always, with the top down.
Yeah, obviously, there is a question in the air right now. Are we in a new bull market or not? Well, let's begin here. The Dow Jones Industrial Average topped back on December 13th. The broad market, including the S&P equal weight, the mid cap 400, the small cap 600, and the Zacks micro cap indexes all peaked on February 2nd. Okay. The S&P cap weighted index has managed to eke out a modest new high in the weeks past, and that's largely attributable to a handful of, overvalued, overowned, overhyped mega cap tech darlings that the usual names, the FANG MT names. These seven stocks have accounted for ostensibly all of the performance in the major averages. And I think the Wall Street Journal kind of put it best when they said, listen, there's been seven stocks that are up 44% based on their market cap and 493 stocks in the S&P that are up 1%. And this was a week or two ago when I read that in the Wall Street Journal. So things have changed obviously through month end. But, the point is simply this: without those seven stocks, the market would be negative year to date. And so, it's not much of a bull market to behold. And we'll talk about it later in one of the slides.
Yep, as you say, we'll definitely dive into a little bit more detail on the quality of this bull market or the rally or short-term bounce, whatever we want to call it. But diving right into your piece, we're looking at your risk model, and it's indicating 50-50 on the risk allocation.
Yeah, no change since last month. Recall that on April 30th, we got a confirmed or I should say negative signal, which carried things down from overweight equities to neutral equities versus fixed income. Recall this is a stock bond model. Basically looks at the S&P 1500 versus the corporate bonds of the S&P 1500 equities. And so, from a stock bond perspective, rates have moved up a little bit, stocks have moved down a little bit, and that's carried this ratio back into neutral territory. Usually, neutral is the first stop before we get a negative signal. Our view at this point is that we have probably topped in the broad equity markets at this point. Whether or not a few, mega cap stocks can carry the indexes a few points higher, we would give it maybe another 3% on the upside, for the cap weighted indexes. But, we're not willing to commit new capital, especially when we can be paid as handsomely as we're being paid by T-bills right now in the 3 to 6 month range at around 5.5%. There's really no reason to take that risk because we think what follows the next 3% up, if in fact we get that, will be a significant downward, plunge to new bear market lows. So, we like the signal that's been triggered in this model to help our subscribers and investors viewing this video to kind of get a sense of what's happening in the broad market and how to position. No greater than 50% equity exposure, in our opinion. And on the bond side, we like T-bills over long dated bonds.
Jeff, before we dive into the weeds, let's take a step back and look at the bigger picture. How does
Yeah.
your long-term economic cycle model look?
Well, like we've been saying for months, this cycle model, which actually looks at 110 years of detrended data in the Dow Jones Transportation Average, which is the most cyclical index of stocks that we can find that we've tested over our over the past 20 years or so that we've been following it. And what this cycle has really done, it's shown a very specific sine wave sort of movement to that detrended, that momentum of that price. And what we've seen is that it was slated to top last year in 2022, and it did around mid-year or so, and rolled over pretty steadily down. Our view really is that we're going to continue to see some deterioration in this model on balance over the next 10 to 15 years. In fact, the model's not slated to bottom until 2039. Now, that doesn't mean that we're going to plunge for the next decade and a half, but it means that there's a negative bias overall to the economic cycle, which means that growth is going to be capped, really. And we think that this whole business revolving around AI is nothing more than hype. I mean, AI has been around for almost 30 years. Look at Deep Blue. That goes back to the 1998 chess match between Kasparov and Deep Blue, where Deep Blue won 2 of 6 matches, or actually 2 of 5 matches. 2 were draws, and Kasparov only won 1. And so Deep Blue, even 25 to 30 years ago, had an advantage from an AI perspective. Now, what has really changed between now and then? Well, we've kind of perfected an algorithm with large language models, et cetera. Maybe that's got some value to search and things of that nature, but I don't think it's an economic, panacea like it's being made out to be in the press. So, I doubt, based on this model, that we're going to see any sort of, dramatic shift in, the growth of corporate earnings or GDP over the next 10 to 15 years.
Well, Jeff, first of all, I want to say I love the word panacea. It's one of my favorite words. So let's have a look at the liquidity dashboard. And it certainly looks like this is a time of extremes almost. What does this all mean?
Yeah, this is probably my favorite chart in the deck right now, because what it shows is that we have been basically draining liquidity from the system. Liquidity is the lifeblood. It's the grease that greases the wheels, basically, of the economy. And what we've seen is real M2 money stock has declined by 9% year over year through month end April. Now, the data is released about a month in arrears, so, a 30-day lag or so. So we won't get the May data until later this month. But, actually that decline of 9.1% is a new all-time record low. Now, the thing that's really kind of been, the question in my mind, I should put it that way, is that if we were, to see some sort of a proportional reaction to the downside vis-a-vis the reaction we saw to the upside when, the Fed and, the authorities basically poured money on the economy, and you saw real M2 money stock grow by 24.5%, which was 150% premium to the prior historic high. Will we see 150% overshoot to the prior historic low, which was up until now minus 6.5%? If we were, that would take us down into the negative teens. That would be effectively equivalent to deflation. And so the question one has to ask when evaluating this data is this a precursor to a deflationary environment? And honestly, based on the larger degree economic cycle, it dovetails very well with that perspective.
Before we get on to the inflation topic, let's have a look at the economic conditions dashboard. It's kind of indicating that we're already in the middle of a recession. Does this kind of play in with a soft landing, or not necessarily?
This data does not suggest a soft landing. This comes from the Conference Board. It's their leading economic indicators index, top 10 leading economic indicators, basically equally weighted. One of those is the stock market. What it's really basically saying is that we should expect a recession anytime now. We saw 2 consecutive monthly negative months in this LEI index back in August, and I think it was July and August of last year. that's usually the trigger for an oncoming period of recession. But based on this index percentage changes, once you break below -4%, that's a 100% historical track record in terms of predicting recessions. We've been below -4% for some time now, and we continue to hold below that level, even though things have stabilized a little bit in April. The trajectory is hard down, and so from our mind's eye, we measured the averages about 7.5 months from those two consecutive negative prints in the LEI. And that gets us squarely in the midst of the second quarter of 2023, right where we're at today. And so it would not surprise me at all if we were beginning a recession as we speak. And certainly the broad stock market is telling you that that's the case. Outside of these 7 mega cap tech darlings, stocks are predicting recession, and so are bonds.
As always, the topic du jour, let's talk about inflation. Are things coming into line?
Well, perhaps, right? I think if we think about what's going on in inflation right now, the Fed publishes this inflation dashboard, which has 9 different models produced by various Federal Reserve banks, and these models basically are calculating core inflation. So, by looking at these models, it gives you a little bit better, deeper perspective on consumer inflation vis-a-vis just looking at the core PCE, which is kind of the Fed's preferred, measure of core inflation. Well, what this is basically telling you is that 5 of those 9 models are well above year-ago levels, suggesting that core inflation is anything but under control. And in fact, we're still some 400 basis points above the Fed's 2% target. Now, granted, that target is self-imposed. There's no economic rule that says inflation has to be 2%. It is what it is, right? The Fed has a goal of getting it back down to 2%. They may change that goal. They may change it to 3%. But what I can tell you is that if inflation averages 3%, we shouldn't expect the same performance from the stock market as we did when it was averaging 2%. In fact, we should expect that 50% increase in inflation to have a very negative headwind for corporate earnings and support higher interest rates, which will lower the terminal value of cash flows for many of these, low-yielding technology companies that aren't profitable at this point.
And with everything you're saying, are your thoughts the same going to the June 14th meeting? Sorry, losing my English here. Do we see a hike or a pause, in your opinion?
Well, we had 2 Fed officials come out yesterday. That was Jefferson and Harker. They're 2 voting members, and both of them insinuated, if not stated plainly, that we should expect a pause at the June meeting. The market believes them to the tune of about a 74% probability. I believe them as well, and I think investors should too.
Just have a look at the yield curve. It's been a decent guide to recessions, but is it fair to say that the re-steepening raises more concerns with you?
It does. If we just look at the 10-year minus the 3-month bill, we just hit a new low for the cycle. We're down, we're 188 basis points negative right now, inverted, if you will. That's a little worse than the 166 basis points that we saw last month. And, I think it's the worst we've seen in 40 years. So, I think we have to look at that, and I think it speaks to the severity of the coming recession. I mean, the deeper the inversion, the more severe. If we look at the 10-year minus the 2-year yield right now, that inversion has actually begun to re-steepen. We've gotten to, I believe, something on the order of minus 76 basis points. And what that's really saying, it's a little bit lower than what we saw a month or 2 ago. That slight re-steepening is usually when you start to kind of see that the recession is not just imminent, but it's occurring. The torpedoes are in the water. That's a phrase I've used before. And I think it's just inevitable before they hit the ship. And, the question is, does the ship list or does the ship sink?
So, Jeff, people can read more in your note on the monthly piece. But is it fair to say that you still favor short duration versus long duration, inflation protected versus fixed rate, and low quality versus higher quality bonds? No real change in that thesis.
That's what we're published at, no question. I would definitely suggest that on the short duration, we favor T bills, 3 to 6 month T bills right now, to collect the highest level of income possible and get the greatest amount of flexibility in terms of liquidity, while maintaining safety and value. Okay, I mean, you're looking at a yield that's greater than the earnings yield on the S&P 500, and that's rare when that occurs. So it's a fat pitch. Okay, as it pertains to tips versus fixed coupon, we're on watch for a reversal on that one right now. And as far as low quality versus high quality, spreads just haven't blown out on the high yield market at this point. And we're starting to see some indication that that might be moving in that direction, but we don't have any hard evidence yet. So again, that's on watch for a reversal. But as it stands right now, we haven't seen a signal triggered and nor confirmed. So at this point, those ratings hold.
So, Jeff, you alluded to this in your opening statement, but week in, week out, you've brought into question the quality of this bull market. And, let's have a look at the chart that you were talking about in your opening statement. It's very telling.
Yeah, behold the bull market of 2023, right? It's nothing really to write home to mom about. If we're talking about the S&P 500, yeah, it's up 8.8% through yesterday's close. That's a year-to-date number, but the S&P equal weight's down 1.43% over the same period. The mid-cap 400's down about 1%. The small-cap 600's down 2.75%. And the Zacks microcap index is down 6.5% year to date. Those are not stellar performances. I believe the Dow is also down 1.5% as well. And so, when we're looking at these blue chip main sort of courses of the market, right? These are the most serious, most investable stocks in the S&P 500. All but seven are in real trouble. And in fact, only 126 stocks in the S&P 1500 are outperforming T-bills year to date through last Wednesday's close, when we did that calculation. And so, I think you just got about a handful of stocks here that, are doing anything. And the media seems to be focusing on, seven.
Well, and that, obviously you look into the market breadth as well, and that's just continuing to weaken as well from what we can see.
Exactly what I just described.
Yeah.
About 33% of the stocks, of all US stocks right now, are trading above their 200-day moving average. And the number of new lows is greater than the number of new highs in the US market across the board. That is antithetical with respect to, a bull market. That should not be the case if we're in a new bull market. And certainly at the age we're at right now, off of the October lows, through end of May, we're talking 7.5 months into a new bull market. You should not see that, that upside down view of strength, broad strength in the market.
That's really quite shocking. Let's have a look at some of these technical levels.
Yeah. So, anyways, we put up a couple of charts where we continue to outline our Elliot Wave thesis, and just to kind of keep it brief here, we've counted primary wave one down into the October low, and we're currently working our way through primary wave two up. We think primary wave two up has the potential to retrace up to 61.8% of that primary wave one decline. That would carry the index to 4312 to be exact. But, we've run into kind of a gap resistance zone here. And if in fact that gap resistance continues to hold, then it could contain the advance itself without seeing any sort of further push higher. That being said, we saw the NASDAQ 100 reach its 61.8% retracement on May 30th, Tuesday. And so if in fact that holds, and if the NASDAQ 100 topped, then I think the S&P 500 has also topped. And if that's the case, then wave three, primary wave three down, should carry prices significantly lower to significantly lower bear market lows. And with that, we would expect the level at which we would expect the market to reach its next sort of a stopping point, its next support level would probably be around 2750 on the high end of a range of 2750 to 2400.
Every time, Jeff. Every time you get me with those numbers. So let's have a look at the back onto the longer term picture. How's the trend looking?
Well, last month we showed the S&P 500 cap weight in our long-term trend following model, and it had turned positive. That was a new development and something that we wanted to highlight. This month, we wanted to show the equal weight version of that. And so looking at the same 500 stocks equally weighted, we actually saw that positive that occurred last month reverse and turn negative in May. And I think that's significant because, again, it speaks to that lack of breadth in the market, that lack of internal strength. And, usually when the equal weight turns down, it is leading the cap weight index. And so I think that's probably what we should expect.
And Jeff, does momentum follow suit as well?
It does, but with a rather significant lag. Just the way this particular momentum model is calculated, it's a long-term model looking at the past year's sort of structure. And if you take a look at the past year, it's been relatively flat on a trailing, 11 to 14 month basis. And so just given that dynamic, I don't expect that model to confirm everything until it's too late. So while we continue to keep it up there as evidence of a potential bull case, I don't think we'll see the support out of that model for a bear case for some time.
And Jeff, I know you've touched on it a couple of times today, but net new highs are looking tenuous at best here.
Yeah, well, when net new highs are making new lows, again, it's inconsistent with a bull market, okay? And if we take a look at the NASDAQ, the broadest measure of the market right now, about 3,664 stocks or 68 stocks in that index, if I'm not mistaken. In May, we saw a new low in net new highs. So, that is concerning. Now, the NYSE, on the other hand, has been relatively stable the last few months. Why is that the case? Well, let me explain it this way. There's 400 out of 2,200 issues in the NYSE that are ADRs. They're international stocks. And so, we've seen international stocks outperforming domestic stocks for, the past 3 or 4 months. And so that's probably why we haven't seen a breakdown. Another thing to consider is another 300 or so issues are bond funds and preferred stocks, which just don't have that sort of volatility. And so, all in, about a third or so of that index is not US equities. And that's how I would explain it. That being said, it's not really doing anything positively.
That's very interesting. I don't think people are really talking about that or accepting that type of breakdown of the NYSE stocks. So the advanced decline lines are diverging as well. Does this continue to play into a long-term bearish picture?
Absolutely. One of my old mentors, Alan Shaw, would say that the advanced decline line is the most important indicator in the market. It's the most accurate indicator in history in terms of its predicting of price change or trend change. And whenever we see these sorts of non-confirmations, albeit they can be resolved, we have not seen them be resolved with an extreme move to the upside in the NASDAQ, both the broad NASDAQ as well as the NASDAQ 100. And we're seeing a relatively recent negative divergence there. That, in my mind's eye, is really sucks all the credibility out of the bull case for the NASDAQ. And without the NASDAQ, the S&P and the NYSE, for all practical purposes, are in just as much trouble, if not worse, because there's no support in those index on a relative basis. These are leading indicators. They tend to precede a major trend change. The one thing that we can't determine with a high degree of confidence is the periodicity between the negative divergence and the ultimate top. We know it's coming, we just don't know when.
So this feels like a Shakespearean sonnet, but where's the volatility? It's still a no-show. Are you still expecting a spike above 40% sooner rather than later?
I do expect that, but I expect it to occur concurrent or concomitant with stock prices breaking down to new lows. And so, this has been a very complacent sentiment rally. It hasn't been extreme either on the bull or bear side, even though we've seen the VIX get down into the teens. That's really not an extreme low. Looking back at history, it's got to be down closer to 10, and so it's still relatively elevated over its long-term history, which tells me that we're still in a period of high risk, right? What I've been looking at, and what I didn't publish a chart this week, but I have in the past. I've been looking at the skew index, and the skew index just hit a new recovery high of 145%. That 145% suggests that there's about a 15% probability of a fat tail event, a left tail event. And so, I think it makes a lot of sense to put on a tail risk hedge right now, right here. You just don't see skew at these levels without seeing some sort of a reaction in the broad equity market in the not too distant future.
So you've been consistent on your valuations about it being too rich as well, and more pundits seem to be coming around to your thinking. And this is ultimately capping the market at or near these levels. Do you still feel the same here?
Yeah, we've talked about current operating earnings estimates, which are currently like $220 this year, $244 next year. This year's estimate 3 months ago was $231, and so that's how fast those estimates can change. And I would say that the 244 was 252, and so that's already come down significantly. It won't surprise me to see 220 turn into 210 in the next 3 months, or 200. Okay. And it won't surprise me to see 244 turn into 220 or 200 for next year. I think these earnings estimates are wild ass guesses, basically. And if we take a look at current valuations using the Shiller CAPE ratio, which is a long-term historical inflation adjusted normalized view of earnings, okay, we are in basically the top quintile, if not top decile of valuations there at 29.3. And, from my perspective, that's a bad bet to buy at 29 times on the CAPE ratio for long-term performance. Can the market go up another 3%? Absolutely. That's a possibility, right? Is it going to go up another 30% from these valuations? Very doubtful. Okay. So my suspicion is that we're peaking in terms of valuations, and certainly the valuations put a cap on the upside. If we look at the dividend yield of the S&P 500, we're at the very, very plumbing the lows, the 2000 lows. If we look at price to sales, we're still above the peak that we saw back in 1999, 2000. And on a book value basis, again, we're in the top decile of book value right now. And so, all these valuation metrics, one that's not on the chart, but, we comment on it every week, is market cap to GDP. We're at 159%. That's not an all-time record, but it's well above the levels that we achieved back in the 99, 2000, dot-com peak. And so, I think we got to consider the fact that we're in the top decile of valuations in most of these metrics, and forward 5 and 10-year returns from those valuations tend to be very, very meager if they're positive at all.
Let's have a look at some sectors here, Jeff. Are there any that jump out to you for more of a focus?
Well, two of them, to be honest with you. Communications, if you're looking for something that might have a positive surprise, I think the breakout that we've seen in the communications area, which has been led by Google and Netflix, and to some extent Meta as well. Those are the big three within that index. Google is really not as overvalued as the other names within that space, that FANG MT space. The average valuation is like 38 times forward 12-month earnings. I think Google's trading at 22 times, more in line with the market multiple of 19 times. And so, I think that would be a name that could potentially lift this higher. There's also a bunch of big cap names in there that are pretty bombed out and could have decent moves. Disney would be one of them, and that would contribute to a move to the upside. Meta, that one worries me. Not so much Netflix. Netflix is another one that could carry higher, although valuation is, not something that I think is necessarily in its favor. It is breaking out, though, from a technical perspective. The other sector that has our attention in a high regard, or I should say, in not such a high regard, is financials. Financials look like they're topping in a classic pattern top formation of the inverted cup and handle variety. And, it looks apparent to me that the XLF, once it breaks 30, is going to careen lower. And it's just a matter of time before that happens. One thing I would say is that, again, everybody's talking about this big bull market. And the fact that we're even positive in May is amazing to me, because 9 out of 11 sectors were actually negative during the month. And most of those were down, anywhere between, say, 4 or 5% to 9 or 10%. These weren't just down fractionally. Maybe 1 or 2 was, but I mean, for the most part, we're talking about 3, 4, 5, 6, 7, 8, 9, 10% declines, 10% in energy. Not that they're going to continue to sustain at those monthly declines, but that should kind of raise your eyebrows a little bit when we take a look at the performance that we saw out of tech, which was up almost 9%. It carried the market.
That's very interesting. Quite a scary breakdown when you actually scratch the surface of these things. So we're liking communications and not so much on the financials. Jeff, as always, we really appreciate you sharing your thoughts from Alpha Insights. And I want to thank our viewers, and I would urge you to check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, good luck investing.